Today I'm going to share 15 high-quality dividend stocks that you may want to consider for your dividend stock portfolio. These are companies that consistently raise their dividend payment year after year. That includes low-yield, extremely high-growth dividends, high-yield, high-growth dividends, and reliable 10% dividend growers like Automatic Data Processing, ticker symbol ADP, which just raised their dividend 10.4% as I recorded this video. If you invest in good businesses, they should continually grow their dividend payments year after year. So with that said, let's get into 15 dividend stocks that just raised their dividend payment. But first, let's roll the intro.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. If you want to use the stock research tool I'm showing throughout, it's all available at dividenddata.com. And right now is the best time to join. We just started our Black Friday sale where you can get 50% off annual membership. And you can lock in that discount for life. There's a 30-day money-back guarantee, so no risk in trying it out. And as you will soon see throughout the video, this is the best research tool for dividend investors, and it's made by dividend investors. The link is in the description and pinned comment of the video. So let's start with Automatic Data Processing, ticker symbol ADP. This just came hot off the presses. They announced they're raising their dividend by 10.4%. That'll be to a quarterly amount of $1.70. This has not yet been fully reflected in our platform, but I'm sure it will be tonight. So the forward-looking annual dividend is going to go up from $6.16 to $6.80. And this will boost the current dividend yield if you were to buy it today to 2.67%. And this has been a consistent, reliable dividend grower. The 10-year compound annual growth rate of the dividend is 12.13%. The 3-year CAGR is 13.98%. And this new 10% increase is in line with their last dividend raise. This is also a very sustainable dividend payment. They have a 50.28% free cash flow payout ratio and 58% based on net income or GAAP earnings per share. And for a more mature, reliable company like ADP, this is a very sustainable payout ratio. Over the past 5 years, this is actually one of the highest dividend yields you could buy ADP stock at. And that's partially thanks to a recent sell-off and the latest dividend increase. And even with the recent sell-off, the 5-year total return is 64%. And going back to 1990, the stock has a 9,755% total return. Next up, we have Snap-on, ticker symbol SNA. They just raised their dividend by 14%. This is another high-quality dividend stock with a 2.85% dividend yield. So you get a nice combination of some yield now plus growth. And this company has been growing even faster than ADP. The 10-year compound annual growth rate is 14.87%. And the 3-year CAGR is 14.63%. And it's interesting, sometimes with a mature company, you see dividend growth accelerate in its later years, and Snap-on's an example of that. Really, since 2013, the dividend growth has started ramping up. And it seems to be sustainable too. The free cash flow payout ratio is 35%. The earnings per share payout ratio is 38%. Oh, and by the way, you can use the AI analyst on dividenddata.com and type in anything like a stock ticker and dividend yield. So in this example, SNA dividend yield. Scroll down, click yield here, and then you can get this awesome chart. And it shows the daily dividend yield of the stock over time. So you can get an idea of what a typical entry point for that position is. With Snap-on, we're right in the middle of the historic dividend yield over the past 5 years right now. It doesn't seem like this yet reflected the latest dividend increase, but at 2.8%, we'd basically be in the upper range of the past 5 years right now. 5-year total return for Snap-on stock is 127%. And since 1990, it's had a 3,800% total return. Next up, we have Roper, ticker symbol ROP. They just raised their dividend by 10.3%. And this is another long-term dividend grower that has sold off a bit recently. And the forward-looking dividend yield is now up to 0.8%. All three of the stocks I've shared so far are quarterly dividends. The 10-year CAGR is 13.79%, 3-year CAGR 13.64%. The 10-year CAGR is 13.79%, And you can see the recent dividend payments have been around 10%. And you notice that this is a lower yield stock below 1%. But in terms of payout ratio, it's a very low percentage of their earnings and free cash flow. This dividend is a 13.8% free cash flow payout ratio and 20.78% net income payout ratio. Next up, I have ExxonMobil, ticker symbol XOM. They just raised their dividend by 4%. This makes the forward-looking dividend yield 3.49%. This is the oil and gas giant you're probably familiar with, Exxon and Chevron. You might own one, you might own the other, you might own both. And this has been a reliable dividend payer for well over 50 years, and they increase it usually on an annual basis. The 10-year compound annual growth rate of the dividend is pretty slow now at 3.5%, and the most recent dividend increase is 4%. This is sustainable with a 54% free cash flow payout ratio and 49% earnings per share payout ratio. But these oil producers are a little interesting because they have such boom and bust cycles. So there are years where it can seem like the payout ratio is deeply unsustainable, and years where it seems like it's too easy, it's 25%. And that's why ExxonMobil builds up a large balance sheet so that they can continue paying dividends throughout the boom and bust cycles. And if we go and look at my personal dividend portfolio, I bought ExxonMobil during 2020 at a great price, and I've reinvested all the dividends since then. And in total, I have a 260% total return on that stock. And my yield on cost is around 10%. From reinvesting dividends, that's gone up to 12.58%. With slower growth companies like ExxonMobil, I like to buy them when they're cheap, when you have a large margin of safety too. So I personally haven't bought any more other than reinvesting dividends in 5 years, but I plan to continue holding and reinvesting those dividends. As you can see, during 2020, when the price of oil was so low and even went negative briefly, the valuations on a lot of these energy stocks compressed significantly, and you could have got in at a very high dividend yield. And your return on investing in ExxonMobil really depends on your entry point. Next up, stock number 5, we have another popular dividend stock, ABBV, ticker symbol ABBV. They raised their dividend by 5.5%. This was the pharmaceutical spin out of Abbott. And since it's spun out, it's been a dividend growth machine. Current dividend yield is 2.97%, but for a while you could have gotten a 4% plus dividend yield on the stock. Now, I haven't been analyzing this company fully, but I am noticing a downtrend in earnings here. So that is something you might want to be concerned about, especially since we're hitting a higher stock price for the company. But perhaps they have some new drugs on the pipeline that I'm not aware of. I do see analysts are expecting increased earnings per share growth in the coming years. ABBV is a quarterly dividend payer. The 10-year compound annual growth rate of the dividend is 11.7%. However, this has gone down significantly. The 3-year CAGR is 5.34%. And the latest increase was in line with these 5% raises. And I would say this dividend payment is sustainable, and that's because I'm looking towards free cash flow and the cash the business is generating. 2024 free cash flow payout ratio of 61%. Now, some of you might be looking at ABBV stock and see the net income-based payout ratio, or GAAP EPS. And this is the default payout ratio that pretty much every website uses, but I think it's flawed because if you look at GAAP EPS, it can take into account many different factors. I don't know what it is with the case of ABBV because I haven't done a deep dive into it, but perhaps they took investment losses on something and they had a big write-down. So that would artificially lower their perceived earnings, even though their cash generation, which is what they use to pay dividends, was not harmed to the same degree. If you want to know more about that, I just explained it a lot in the video I recorded yesterday, so go watch that. It's on the channel Dividend Data. Just look at yesterday's video. So the net income payout ratio shows a 257%. And what that would mean if that were true, it would mean that the dividends that the company is paying out are 2.5 times what the company is earning. But ABBV is one of these examples where the net income payout ratio has been overly inflated in the past when you compare it to the free cash flow. Even the years where it was 80% EPS, it was 40% in free cash flow. As I mentioned, you could have gotten ABBV for a while in the 4% yields, and even as high as 5 and 6% in 2019. And since it spun out of Abbott in 2012, it's been a pretty good compounder in the market with over a 1,000% total return. The 5-year total return is 185%. Next up, we have Murphy USA, ticker symbol MUSA. They raised their dividend by 18.9%. Now, this is a low-yielding stock, currently 0.7% dividend yield. And I've never done a deep dive onto this company. It came into my radar by looking at those dividend increases, and it was pretty good dividend growth. Now, what's interesting is that they have been raising their dividend payment every single payment. 5-year CAGR of the dividend is 20.3%, and this latest 18% increase was way to the upside. Now, they only started this dividend back in 2020, so it's only had about 5 years of consistent raises. But the payout ratio is very low, 7% EPS payout ratio, 9.4% free cash flow payout ratio. Now, one thing I am noticing is that over the past year, the stock's down 32%. And a brief look at most of the financial metrics like earnings per share and free cash flow, it's kind of declined in the past couple years. So that would be something to look into if you're considering buying this stock. Next up, we have one of my top high yield dividend stocks that you can buy. In my opinion, I've added it to my portfolio. That's MPLX, ticker symbol MPLX. They just raised their dividend by 12.5%. This is a midstream oil and gas stock. It is a limited partnership in this case. So for taxes, it's considered a distribution, not a dividend. And you will have a different tax form when you own one of these. So it would be in a K-1 document. I personally am comfortable with this, but many people don't. If you have a tax professional you use, sometimes they charge more for K-1s. But here's the thing. This stock has an 8.27% dividend yield. The MPLX dividend has grown at a 5-year CAGR of 9.38%. The latest increase was 12.5%. The one prior to that was also 12.5%. And this is a company that I own, and I've been listening to their earnings calls and all of that. And they kind of already hinted that this 12.5% increase was going to happen. And they foreshadowed that that is the plan for the coming years as well. So the fact that you can get a stock yielding 8.2%, growing the dividend over 10%, heck, if it was even 7 or 8%, that'd still be awesome. MPLX is in rare company. And if you're a high yield dividend investor looking for growth, this is probably a stock to consider. This is now the third largest dividend payer in my personal dividend growth stock portfolio. MPLX is interesting because I wish I had this on my radar during 2020 in that same oil crash. You could have gotten the stock for a while at a 14 to even 16% dividend yield. And if you were really on the ball during March 2020, you could have gotten a 20 to 30% dividend yield. And this has led to great returns over the past 5 years, 314% total return. And this stock has been kind of weird over time, and your returns really depend on when you bought in. For some reason, a lot of midstream oil and gas stocks in 2015 were really overinflated. So that was kind of like the worst time to buy. But basically since then, if you've held and reinvested your dividends, it's done pretty well. And related to MPLX, we have Marathon Petroleum, ticker symbol MPC. They just raised their dividend by 9.9%. Now, the reason why it's related is that Marathon Petroleum is the oil producer that actually owns a large percentage of MPLX. MPLX is the midstream transportation company for the production assets of Marathon Petroleum. They have grown and invested in other things as well, but this is their key sponsor. So much so that the CEO of MPLX and Marathon Petroleum is actually the same person. Now, I personally like the economics of this business much less because it has all the variability around production and commodity prices that cause earnings to fluctuate a lot. The current dividend yield is 2.02%, but it has been a reliable dividend grower. 10-year CAGR of the dividend is 12%. The latest dividend increase was 9.89%. And as of earnings in 2024, this was a very low payout ratio, 18%. 33% based on net income. Also somewhat interesting, this company has been repurchasing shares like crazy. But similar to ExxonMobil, you should expect slightly lower earnings and free cash flow as the commodity price of oil comes down. Next up, we have Rollins, ticker symbol ROL. They just raised their dividend by 10.6%. And the charts here look pretty good. As you can see, there's consistent earnings per share growth at a pretty high rate. The price has largely followed that as well, although the 5-year price return at 50% is much worse than the 10-year at 400%. Seems like it struggled for about 3 years coming out of 2020. And this is a consistent dividend grower for their base quarterly dividend. I haven't done a bunch of research on the company, but what it seems like is that it pays large special dividends too as well. 10-year CAGR of the dividend, 8.6%. This is a 1.25% dividend yield, so it's a lower yielder. Free cash flow payout ratio, it's 51%. Earnings per share payout ratio, 63%. I would say it's sustainable, but on the high end for a low yield stock. Next up, we have one of my favorite dividend growth stocks. That's Visa, ticker symbol V. They just raised their quarterly dividend by 13.6%. This is the payment network giant, Visa and MasterCard. You are likely familiar with them. I have a full stock review on Visa stock if you want to go back and watch it. They'll dive into a lot of the competitive dynamics with it. It's truly a great business, and they have tons of network effects that benefit them. It's also a high margin money printer, this company. They basically have 80% gross margins, 50% plus net margins. And in terms of the dividend, it's a low yielder, 0.79% dividend yield, but consistent high dividend growth. 10-year CAGR, 16.9%. 3-year CAGR, it's got a little lower, 14%. And the two recent increases have been 13.5%. It is a sustainable dividend payment as well, 21% free cash flow payout ratio, 23% EPS payout ratio. They're also repurchasing shares consistently. That's another way that they return capital to shareholders. And if you're wondering if you can ever nab this company at a higher dividend yield, no, it's always a low yielding stock. It's never really been above 1% consistently. And the reason is it's such a high quality business. It trades at a premium. And relative to their earnings and free cash flow, it's a low payout ratio. Since going public in March 2008, the stock has a 2,297% total return. Next up, we have DR Horton, ticker symbol DHI. They just raised their dividend by 12.5%. Current dividend yield for the stock is 1.23%. The 5-year compound annual growth rate is 20.7%, so this has been a great dividend grower. The 12.5% is actually on the decline. Their prior dividend increase was 33.3%. And the reason why it can grow the dividend so fast is the payout ratio is pretty low, 15% based on fiscal year 2025. That's for free cash flow payout ratio, and 13.8% for net income-based payout ratio. This is another company that has been repurchasing shares as well. For stock number 11, we have HES Midstream Partners, ticker symbol HESM. If you're a viewer of this channel consistently, you know this is one of my biggest buys recently. They just raised their dividend by 2.4%. And you might say, Zach, that doesn't seem like a lot. Well, let's dive into the details around that. HESM is a company that raises their dividend every single quarter. At least that's what they have been doing going back to 2017. This is another midstream oil and gas stock. It was originally a limited partnership, but they actually had a tax restructuring so that it's what's called an Up-C corporation, which means to you, you don't have to do the K-1 forms for HESM, and it's just normally on your 1099 div, same as all your other dividend stocks. But you still get that extremely high midstream oil and gas, high yield. This is 9.06% for HESM because it sold off a bunch recently. And I used that as an opportunity to load up. I'll show you my portfolio in a bit. 5-year CAGR is 11.31%. Yeah, and they just had this 2.42% increase. The one prior was 3.83%. The one before that was 1.23%. Based on free cash flows, is very sustainable. Again, net income's a misleading one sometimes with various types of companies. Midstream oil and gas pipelines, one of them usually. And actually with these partnerships, you want to be looking not even at free cash flow necessarily. They have distributable cash flow. They have adjusted EBITDA. Those are very good financial metrics for these types of businesses. And if you go and watch my last HESM deep dive, I walk you through my full explanation of why I bought so much of this stock. I'm not going to do all that today. This 9% dividend yield's on the highest end that you could have bought over the past 5 years. However, similar to MPLX in 2020, you could have gotten a 10% yield and even as high as a 20% yield during the dip. The 5-year total return for HESM is 188%, and that's even with the recent sell-off. Prior to the sell-off, it was 250%. In my personal dividend growth portfolio, that I have this as the #1 holding right now. I have bought a crap ton of it over the past few months. I'll probably continue to add to the position over time. This company pays me a $6,700 annual dividend right now, and I look forward to reinvesting that and seeing that dividend snowball compound. Again, this is not financial advice in this video. I'm just sharing what I do and my research tools. If you want a full explanation for why I bought so much HESM, go and watch my portfolio update from, I believe it was 2 portfolio updates ago. That's a 45-minute deep dive video. Lots of high quality information in there. For stock number 12, we have a very interesting company that I was covering back earlier this year, and I wish I just did a deeper dive into it and actually bought it during the tariff sell-off because it's crushed it since then, and I knew mentally to do it. I told other people to do it. I didn't do it. That's Comfort Systems, ticker symbol FIX. They just raised their dividend for the 5th time. And by 5th, they mean 5th consecutive time. This company has been a rocket ship of dividend growth as of late. The latest increase was 20%, and the 5 prior were all over 10%, some as high as 16%. If you don't know Comfort Systems, this is an HVAC company, and it's kind of just exploded recently because they have so much excess demand from the data center build out. and this is basically one of the leading companies in the US for HVAC services. I'll probably do a full deep dive video on this because it's one of the sneakiest AI stocks that people just don't even know about. As you can see, their earnings per share have exploded in recent years, and the stock price has followed suit. Over the past 6 months, the stock is up 114%. Again, that April tariff sell-off, I wish I was on this. I made videos about it, but I didn't buy it. I did all right, though. I bought a bunch of Google then. That has also done well. And if we take a look at the dividend for fix, it's a very low yield stock, 0.25%. So you're not necessarily buying this for the dividend, buying it for the growth, but it is a dividend growth stock. I mean, when you have a 3-year CAGR of 62%, you're a dividend growth stock. This is one of the more absurd growth summaries I've ever seen for a dividend stock, by the way. And you might say, oh, this company's so overvalued because the yield's so low. Well, based on 2024 free cash flow, that's a 5.7% free cash flow payout ratio. So this dividend is nothing in terms of their earning power. It was 8% based on GAAP EPS. And so far in fiscal year 2025, their free cash flow has exploded to all-time highs. And overall expectations are continued high earnings per share growth in future years. The stock really doesn't even trade at that crazy of a multiple. I mean, you could argue that it's pretty high because it's not like some super scalable software, high margin subscription business. It's just a normal services business, but really growth is growth. That's kind of all what fundamentally matters. The total return for this stock is nuts, 7,600%. That's going back to 1997, but really the stock was in the wilderness for 20 plus years. The 5-year total return for this company is 1,800%. Awesome. This is one of the best returners in the market. Nobody's talking about it. Since I just talked about a company nobody knows about, let's talk about a company which everyone knows about. McDonald's, ticker symbol MCD. They just raised their dividend by 5%. And this is a very mature company, but it consistently grows its dividend payment every quarter. The current forward-looking dividend yield is 2.42%. 5-year CAGR is 7.59%. The most recent dividend increase is 5.08%. Recently, they've been doing 5% dividend raises. This dividend raise and the last one was around 5%. Prior to that, they had two around 10%. So it is slowing down a little bit. The payout ratio is sustainable, 72% free cash flow payout ratio, 59% EPS payout ratio. The dividend yield for McDonald's is never really high. The best you could have gotten it was high 3%. Past 5 years, it's never gotten above 3%. The 5-year total return for McDonald's stock is 61%. Finally, we have Brown & Brown, ticker symbol BRO or BRO. Some people have actually been buying this in our Discord community recently. You get access to that when you join dividenddata.com. They just raised their dividend by 10%. And the reason why people have been buying it is it sold off a ton from their high of $124 a share. It's currently $80 a share. Stock's down 28% over the past year. This is a low yielding company. The current dividend yield is 0.82%, but it has been a consistent earnings grower over time. If we look at the BRO dividend, 10-year CAGR is 10.3%, but this has accelerated in recent years. They just did a 10% increase. The one before that was 15.3. One before that was 13. Free cash flow payout ratio is very low, though. So that's the reason for the low dividend yield. It does not mean that they trade at a high multiple necessarily. Free cash flow payout ratio is 14%. EPS payout ratio, 15.5%. Over the past 5 years, BRO stock has never had a dividend yield above 1%. And after the recent sell-off, the 5-year total return is 76%, but that was well in the 100%, around 140% as of May. But that wraps up the 15 high-quality dividend stocks that have been raising their dividend payments in recent weeks. If you enjoyed the video, make sure to leave a like, comment, and subscribe to the channel. And if you want to use the stock research tool I showed throughout, it's all available at dividenddata.com. Right now is the best time to join because we have our Black Friday sale, which just started. You can get 50% off annual membership and lock in that discount for life. The link is in the description and pinned comment of the video. It's the best time to join. There's no risk in trying it out. We have a 30-day money-back guarantee. With that said, I'll see you in the next video.